Hey, everybody, this is Charles Dobbins, and welcome to this week's edition of the Multifamily Investing Academy podcast, where I tell it like it is. And here I have Joe Viery of Cost Segregation and Energy Tax Credit. No, yeah,
That's good. I'm sorry. That's not the name of the company.
no. The name of the company. Oh man, look at this. How do you like it when I just wrote down all my notes? It's U.S. Tax Advisors. So it's
There you go.
USTAGI.com.
Excellent.
US Tax
Sorry, I
Advisor.
interrupted you.
Yeah. Wait, what's the GI for?
Group Incorporated.
Oh, US Tax Advisors Group Incorporated. Gotcha.
Yes.
Where are you out of, Joe?
We're nationwide, but I happen to live in San Diego.
Oh, cool. All right, cool. So anybody can use you anytime.
Yes.
Right. All right. Now, let me ask you, I did some research on you. I got some, I love telling stories, and you're going to tell some stories in a moment. But, one of the things that it said, well, you're going to say something? You're going to hit, okay.
I'm going to listen.
One of the things that you'd said on your website is that you specialize in engineering-based cost seg studies. What does that mean? What are my options here?
Okay, so we play by the Bible, which we call the Bible, which is the Audit Technique Guidelines, or ATGs, for cost segregation. The reason I mention that is because if anybody wants to know how we operate, it's published by the IRS. Then all they need to do is Google ATG for cost segregation and look at the IRS 200 and plus page document, and we go down and we provide quality studies as per their direction. And what their number one study looks like is an engineering-based study. They want an engineer, a construction engineer, to perform the calculations needed for cost segregation, and that's what we do.
Okay, so basically, your competition, what are they, more accounting based or something? Or because I read in one of your references that the guy, one of your clients, went to two accountants to talk about cost seg, and they pretty much got the brush off, which I'm not surprised, because if you have to ask an accountant to think outside the box, it's not going to happen. So so your staff, not just accountants, you've got to have engineers on there as well?
Yes, of course. And that's the difference. So there are a lot of accounting firms that offer cost segregation. Now, I will be totally fair. We're completely above board. So I am not going to trash or say anything negative, because these accounting firms.
Come on, man. I got to get my ratings up, Joe.
No, I'm not going to do it.
Get my ratings up, man. Come on.
So what a lot of these accounting firms do is they will hire a company like ours, and they will just brand it their name, and so they will be engineered based. But then some of them go the opposite side, the dark side, where they basically don't really have anybody of authority on their staff, and they just do the studies themselves. And that would be the risk involved with that type of a study. If you're not an engineering based firm and you cannot defend your work to the IRS, you risk being audited and losing.
Okay, so what type of things do you need to defend against with the IRS? What do they come after you for?
If you go down the list, they're going to be looking at a lot of different things. But number one, who did the study? What type of reputation do they have? Do they know their work? I've been in the industry since 2007, and I don't know how many studies. Everybody gives all these numbers out there. I have no idea, and I'm not gonna try and figure it out. But probably I would be safe to say 20,000 studies, and our work has never been audited by the IRS. Is that good, bad? Let the individual decide. But have I been questioned by the field agent? Of course. And we will talk to the agent, and after the agent gets the answers to the questions, for example, like, how did you calculate the price of that linear foot of countertop? Well, we'll tell them we use RS means. Well, RS means is what the IRS wants you to use to give all the figures. There's two, Marshall and Swift, and RS means. So obviously we tell them how we calculated. They say, thank you, sir, goodbye. And that's the end of our question.
Okay. One of the things that obviously I'm multifamily. Now we're starting to do hotels, 2 multifamilies. So it's, we're always talking about cost segs. But in your bio, you actually talked about doing a cost seg on a single family residence. Yeah. Okay.
Yeah.
What's that all about?
I know that's crazy good, because we're one of the few that do this. And there are some competitors out there, but the difference, and there may be more. I am blessed because I'm really busy. So I don't really get involved in my competitors, and I'll only get involved if somebody calls me up and says, hey, what about this company? I'll give them my honest opinion. If they're a good company, I'll say, hey, I like those guys. I know them. They're good. They're reputable. They're engineering based, and I have no issues with that company at all. But I've seen some that work out of a garage, and they're pretenders is what I call them. So bottom line is, what we've done is, my competitors, when it comes to single family homes, is they have the client go online and do all the work, and then they do the calculations and they give them the report. We're different because we do all the work. So my engineers still do all the work, but what we do is, if it's a building with a basis of $750,000 or less, we will do an analog or analytical type of a study. So what does that mean? That means I don't need to fly to the building and do the measurements. We gather all the information from the client, and a lot of different information. Like, say, we may want photos, we may we want appraisals, we want documentation such as closing statements, and then we'll go online and we'll see what kind of information on the building is online. And if we get enough information where we can do an analytical study, then basically that's going to save the client lots of money, because we're not flying all over everywhere to go and do those calculations. Now, unfortunately, if the building is over 750,000 in basis, we still have to do it the detailed engineering method, which means we go out there and we measure, document everything. But for the modeling studies, we do that in-house. And basically, it's not now I won't fool anybody. It's not the number one in the hierarchy what the IRS wants, but they recognize modeling as a legitimate way to do the building. And I will tell my clients, hey, you're not going to get the yield. So what do I mean by the yield? So I'll just throw out a number. You have $1 million, let's do $100,000 building basis. And with modeling, I can estimate that I'll find between probably 22 and 25%. I will admit, if I went to the building and did the calculations, I probably would find closer to 30%. However, I'm going to charge thousands of dollars, and it won't be worth it. So why not do the modeling? At least you're going to get a reputable, reliable report. You're still going to get accelerated depreciation. The yield is not going to be 30%, but it's going to be pretty darn good. And so we do all the work in the modeling studies, and it's a way for those that in any type of building. So if it's a multifamily, it's small multifamily. Let's say it's a 6-unit apartment complex in, I'll make up a state, Alabama, and it's under $750,000 in building basis. We can do the modeling study on that building, that multifamily as well.
Okay. Now, what about tax credits, energy tax credits?
Well, you know what?
As well?
We do. And you know, one of the reasons why you do not do accelerated depreciation, if a client tells me, prospective client, that they are not going to hold the property for at least a year and a half minimum to 2 years, we prefer longer holds, like 4 or 5 years would be better, but I can live with 2 years. And it's a mathematical equation to see if it's going to pencil out or not. And what am I looking at? On the mathematical side, I'm looking to see, what will the client do with the dollar? What's their IRR? What's their internal rate of return? If they've got a crazy high return, internal rate of return, then I would say for a year and a half or 2 years, you can do cost segregation. The reason why, it's because of depreciation recapture. So if you're not holding the property for at least 2 years, you're going to have to pay back some of the depreciation. And so if you do all the math, it's not worth it. So we would tell flippers, okay, you can't use accelerated depreciation. But now with the Inflation Act that passed in September, they changed the rules of the road for the 45L energy tax credits. So for the value add investor, and most of my clients are value add, what do? They buy a building, they fix it up, and then they sell it. Well, if that's the type of flipper you are, which is probably what every flipper is, now you can go back. If you've increased the energy efficiency of the building when you did the renovations by 50% over the 2006 standard, you're going to qualify for a look back study, meaning 22 and back for 3 years, I can give them a $2,000 per door. So if it's a multifamily, that's per unit, or single family per door, I can give them a $2,000 tax credit. The important thing to realize is the tax credit is not depreciation. A tax credit comes right off what you owe. If you owe $100,000 and I give you a $2,000 credit, have you reduced it by to $98,000. So now what I love about flippers, and they don't even get this yet, meaning they've not put all of this together and their accountants haven't, is they can go back 3 years. And I'm talking about if 3 years ago they did the work, they improved the property, and they can qualify for that 50% over the threshold, they can go back even if they sold the property, and they can apply the $2,000 tax credit to their taxes. So that's huge. Now, going forward, it bumps up for 23 up to 33, 2033. It bumps up to $2,500 to $5,000. Wow. But there's a lot of movement, and I'm not the energy engineer. I would invite those to call me and they can talk to my energy engineer, because there's a lot of moving parts to it now. The old way was that 2002 guideline. Now it gets into all types of like, is it Energy Star compliant and yada, yada, yada. So I'm not going to talk about that today, but the point is that if you've done any improvements and what am I talking about for energy? I'm talking about the basic three are this: HVAC is one. The envelope of the building is 2, meaning the doors, the windows, the insulation, the roofing. If all of that is energy compliant, and there's ratings for example, in the insulation. So if we know what your R rating is for your insulation, we can tell you, okay, sorry, you went too cheap. That's not energy compliant. So we do all of this at no cost. We will let everybody know before they pay us a dime if we think they're going to qualify. And then the third part of it is the appliances and the light fixtures. So if you put in new LED, you put in a new water heater, you put in new appliances in the kitchen, those nowadays probably are going to be energy efficient. And if you take all of that and we determine, yeah, you're going to qualify, then you would move forward with the tax credits. So it's pretty powerful. And I'm telling you, a lot of taxpayers out there don't know it.
Yeah, a lot of flippers don't know it. No. And you get a 2 to 3 year look back as well.
Yeah, 3 years. So we can go back to 2020 right now. If you sold it in those 3 years, we can still go back and now. Keep in mind, you're going to have you have to have your documentation to prove what you did. So we don't do anything based on hearsay or make up. We don't make stuff up. So you have to prove to us, okay, what kind of HVAC did you put in there? Okay, what kind of insulation did you put in there? What kind of windows? What kind of doors? And then we can determine whether you're going to qualify or not.
Wow, that's amazing. Folks, USTAGI.com. If you want to talk to them and find out if that impacts you, that's fantastic, Joe. Okay, so you talk about a free estimate. What does that entail? Here I am. Let me just tell you, we're waiting today to hear if we got an accepted offer on a hotel, and the hotel will eventually want to convert it to multis. So when would I call you for that deal? Now, okay.
Yeah, and we're not gonna charge you, and you don't have to give us any money, but yeah, we're gonna lay out what the progression of the work will be and what the value would be for you. You want to know the estimated benefit. Okay, if I'm going to give you X in dollars, what are you going to give me? I'll tell you my mathematics, and this goes back to a long time ago, and everybody can argue with me, and I don't care. It's basically, I feel that we should give you at least 10 times our fee. So if I charge you, I'll make up a number, $1,000, I want you to save at least $10,000 in taxes. If you don't save in $10,000 in taxes, will we still do the work? We will, but I'll tell you to your face, I don't know if it's really worth it for you to do it for less than 10 times, but if you want to do it, God bless you, do it. So why do I need the information on the property? Because in the one you described is going to be probably a multi-phase property. The first phase is we got to get the benchmark. How do we get the benchmark? We have to see the property as you bought it. I don't want to see it 2 years down the road. we're very good at going back and putting the pieces together, but it's a lot easier if we can just go and do the first study, which is the acquisition study. So you buy a hotel for, I don't care, $10 million. I made up a number, $10 million. We go in and we're going to give you a study based on the $10 million acquisition. Now you're going to convert it to multifamily. What are you going to do? You're going to rip walls down. You're going to take out, of course, carpet and this and that and all of the stuff, and you're going to make it into a multifamily. Everything you throw in the trash has a remaining basis, which is a tax write-off. The IRS in 2014 came up with the tangible property regulations that gave all taxpayers the rules to the road, because the IRS was tired of getting beat up and taking people to court. So they said, here you go. Here's all the rules to the road. Well, one of the rules which really helps the taxpayer is they don't want you to have two roofs on your depreciation schedule. Well, what do I mean? Okay, you buy a building, and if you do a quality study, guess what we're going to break out? We're going to break out all of the building components. What's one of the components? The roof. So you've got a roof baked into that $10 million hotel you're buying. You've got a roof in there. You don't know what it is, but I do. So it's baked into my report. So now you put a new roof when you're converting it to multifamily, and now you're going to depreciate the new roof because it's a capital expenditure. Well, guess what? That's two roofs down. You're depreciating the roof you bought 2 years ago with well, let's say you did it in 2 years, the renovations. Now you got a new roof. Well, that's two roofs. The IRS says, no, we want you to write that old roof off. So now you've got the keys of the kingdom in my report to now expense that old roof and write it off. Well, I use the word expense. Guess what every taxpayer wants?
More
expenses.
Expenses, exactly.
So now my report gives you all of the expenses when you throw stuff away that has value to it. And everything's got value. Even small items have value. And then the third part of that study would be all of the improvements you've done converting it to a multifamily. You're now going to spend, I don't know what, I'll make a number up again, $1 million, $2 million, whatever it is. Well, now you're going to cost seg, you're going to accelerate that. So that's a 3-phase study. And I want you to start from day one, because if I have to go back and I have to try and figure out what it looked like before you started ripping stuff out, it's going to take me more time, and our fees are based on engineering time. So it's going to cost you more.
Yeah. Okay. All right. That great answer. Great answer. I'm going to give you 2 stories. All right. And I want you to give me the background on these stories. Okay. So, I'm reading your website here. It says, the guy says, I own a hotel, and on your testimonials on your website, you give the actual person's full name. So when the guy said, I own a hotel, I knew right away what his last name was.
Okay. Sorry. Okay. I'm going to change that and make it up.
Yeah. You could do Rav P, and P would rhyme with hotel. Hotel. Yes. Okay.
Okay. So, fair enough.
The good news was that, okay, this next statement, and I think really the real reason why I'm raising this one is because I didn't understand this next statement. He says, the good news was that I had my loan refinanced, which reduced my monthly payments, but resulted in owing the IRS over $100,000 in income taxes. How did that happen?
I don't know. That was between him and the IRS.
Okay,
it's his accountant, actually. So he came to me. That was a great story, and I'll just make it real quick.
Yeah.
So I walked in and I said, and the owner was there, because a lot of owners for hotels are there. And I said, this is what I do. And he goes, no, I don't need you. Go away. I'm fine. Okay. He calls me up 6 months later and goes, Joe, can you come and talk to me? I come and talk to him, and he goes, okay, this is the story, but I don't know the details. I could get him. He says, I got a refinance offer by the bank, and it was incredible. It saved me a lot of money, but guess what? Now my accountant is saying I owe $120,000 in taxes. Yeah. I don't have $120,000. This was in 2008. He wasn't making any money. His business was nothing. So he goes, I don't have any money. So I made him a great deal. I gave him a great deal on the fee, and I did the study. I came back to get the second half of my fee because we charge a retainer. And he goes, Joe, you saved my butt, man. You wiped out the $120,000. But he goes, I'm serious. I don't have any money. He goes, so, my best friend owns XYZ company. I go, I never heard of him. And he goes, you never heard of them. He goes, well, they're the biggest company in San Diego, Joe. They own billions of dollars of real estate. They're in the top 50 of hotels, top 50 of senior centers, top 50 of multifamily. I never heard of them. So I just walked in the door, and I've been doing their all of their studies since 2008. So the fee that he owed me, I definitely forgave him, but I was able to save him the $120,000, which was the great news of the story.
Oh, that's cool.
Yeah.
Very cool. All right. You see, this is what I love about this. I get to play, tell me a story. All right. So here's this next one that kind of threw me from Kate. She said, huge cost seg success story. I first learned that cost segs existed from a Facebook reel or a TikTok. Okay. Well, she's top of her game. We own 4 rentals, and I asked 2 accountants. See, this is the story that I thought was very interesting. She says, I asked 2 accountants for the process to do them. One said it was too expensive to do and wouldn't make sense on any property less than $1 million. Our 4 properties range in purchase price. Submitted a quote request to U.S. tax advisors, was quoted $2,200 to do 4 studies with an estimated $350,000 they would find in depreciation. Okay, 8 days later, they totaled with $450,000 in depreciation. We can't count it against our ordinary income. It saved me, we can count it against our ordinary income. It saved me $167,000 in taxes. Thank you for this group. Shared all these numbers. I shared all these numbers to show exactly what a difference it can make. That's powerful stuff. That's powerful right there. Now,
those were modeling studies, so we did it analytically. And I don't remember her. I know that we get a lot of those.
Yeah.
Okay. Anyway, but I don't remember Kate. I probably didn't deal with her, but I'm pretty sure I know the group that she was referring to, how she found out with us from. I don't even know how she found out, but that's what happens. Most accountants don't know that we can do the analytical type of study, and they think that it's going to be $1 million building. They don't know that we can do it without having to go there and fly there and measure everything. So that's the takeaway, is that if you know anybody that even owns single family homes or small duplexes or fourplexes or small hotels, we can do the analytical study. And like she said, she owned 4 single family homes, and we saved her over $100,000. Now that's the tax savings. That money stayed in her wallet. She would have had to write a check to the IRS, but we came along and we saved her that money, and she was able to buy more property.
Yeah, that is so cool. Okay, this one's a good one. Guy had a phenomenal year, 2022. He says, I was anticipating owing a little north of $100,000 in taxes, and I asked my CPA to give me a heads up on what he thought I would owe before he sent me the numbers, so I could be sitting down when he sent it to me. He sent me the figure last night, and I only owe a little over 50 grand. He says, I thank these people for introducing me to U.S. tax advisors who ran a modeling cost seg on my rental properties and saved me roughly $40,000 in taxes. Brett has time and time again said taxes are your biggest expense, and we need to focus on how to reduce that burden. That one thing did decrease my tax burden by almost 40%. That's it. You listen to all these guys talk about wealth and how to create wealth, and they all talk about saving money, not paying taxes. If you're not doing cost seg on your properties, you're an idiot. You're an absolute.
Now, here's one little, I'm fair, and I tell everybody, okay, why wouldn't you do cost seg? Well, there's not very many. I distilled it down to four. I don't even know if I can remember all 4, but it's 4. One of them is if you're not paying taxes. Well, you don't need to call Joe, because if you're, a lot of people think that for some, I say no. If your accountant didn't say write a check to the IRS, you don't need me. When he does say write a check to the IRS, call me, and then we can work with you. Number 2 is if you do a 1031 exchange, but not all 1031 exchange. I'm going to put a caveat on it. If you do a straight exchange I'll make the numbers up again. You sell a building for $1 million and you buy a new building for $1 million. There's nothing for me to accelerate, because the $1 million you sold to bring over into the new property is going to be frozen in straight line. I can accelerate that basis. However, what most people do, if they're smart, and most of my clients are smart, they sold the building for $1 million, they bought another building for $2 million or $1.5 million. All of that excess over the million I can accelerate. So if you do an exchange and it's a straight exchange, or let's say you bought a new building for 1.1 million, I would tell you it's not worth it. I have 100,000, forget about it, move on. It's not worth your time or my time, and I'm not going to take your money. So those are some of the reasons why you don't do. If you're not paying taxes and you do an exchange, but the one wild card out there that some people still cling on to is depreciation recapture. And I mentioned it a little bit. Yeah. However, I can go into this, but I can just give you the icing on the cake is actually cost segregation reduces depreciation recapture. Now, you still have to own the building for, a year and a half to 2 years. I'm not taking that off the table. All I'm saying is that if you do own a building for 5 years and you've done cost seg, basically your accountant should be able to take the 5-year property and say that there's very little left of the 5-year property because you've owned the building for 5 years. Makes sense? You pointed at the carpet, that's 5-year property. Is that carpet worth anything after 5 years in a hotel or a multifamily? Hell no. What I mean, it's maybe if you can sell it to a third world country, but no one's going to buy that carpet. So it's got no value. So that goes off the table for depreciation recapture. The 15-year property, which is the land improvements, you've used a third of that. So that comes off the depreciation recapture. So in essence, cost segregation reduces your depreciation recapture, which a lot of accountants, because this is high level, I'm not giving you tax advice because I'm not an accountant, but I'm telling you, my accountants who know this tell me this is the strategy they use to reduce depreciation recapture. So just have it in the back of your brain and think about it, because when you do sell a property and you get that conversation with your accountant, then you can tell them, well, wait a minute, Joe said that cost seg reduces depreciation recapture, and you can call me and I'll talk to your accountant, whether you're my client or not.
Cool. Hey guys, his name is Joe Viery of US Tax Accountant Tax Advisors, GI.com, USTAGI.com. I highly recommend him. I've never seen one guy more excited about cost seg than Joe.
That tells you how sick I am.
I know, exactly. You'd fit well here in this firm. So, right. All right. Well, I tell you, I'm going to be talking to you hopefully later this week, because we might have something to talk to you about. That'll be a lot of fun.
That would be great. I look forward to it.
Cool.
Thank you, Charles.
Joe, thanks so much for being on my show.
You're welcome. Thank you for having me. Appreciate it.
I'll talk to you soon.
Bye-bye.
Bye-bye.